Today, folks, you gotta stop calling me Jimmy Neutron. I fixed my hair, okay? I know, 90s kid, faux hawk. What do you want from me here? As we dive into the portfolio, the markets, what's happening here as people are kind of blindsided by the fact things are hyper inflated and continue to inflate, with the Shiller PE now hitting levels not seen since the dot-com era. In fact, higher than where it was in the 2021 boom, where so many of us made small fortunes but locked in those profits. However, I want to broad view my $368,000 Canadian stock portfolio with my individual plays, the strategies around those plays, and the broad view of my accounts and where I want to see myself in the next year, presuming the market continues to at least be somewhat stable, but I'd prefer to see a correction or something to start justifying the values, because earnings were great, but they weren't that great, especially with some lowered guidance out of major tech companies. However, we have tons of other news we're going to get into. Ray Dalio has been buying Tesla stock. Chinese stocks are absolutely pumping. The Canadian dollar is rallying back, and so much more. So if you're on a path to financial independence, if you damn well one day want to retire early, join me by simply hitting that subscribe button, folks. And if you like my portfolio tracker, you want to support the channel, go to kylelivingston.com, a link in the description below. Try it for yourself. Now, we're sitting at about 368K, propelling to all-time highs, but only because I've been adding a lot of capital and buying a lot of new stocks pretty aggressively. You can keep it in the total gain, the total return, including the dividends. Not sure. I've got about $384. Next month dividends will be great. Most of my stocks pay quarterly, but we're up about 2.56%. And we're going to come back to the broad view in a moment, but let's take a look at the markets for the week, with the stocks as usual being highly spattered. The worst performers like Apple rebounding this week, Nvidia doing really well, knowing that mega tech companies are continuing to spend capex. Meta hit all-time highs again this week. Google continued to go a bit lower this week. A lot of the stocks I hold are, again, all over the place. If we look at the TSX, however, we saw TELUS, that I've recently been buying, rallying pretty aggressively. Shopify is starting to propel back to some highs we haven't seen in a very long time. But otherwise, energy is getting kind of slapped upside the head. Enbridge, C&Q, we're seeing some pretty down plays to the pipeline players there. And if we take a look at my biggest position, the S&P 500, we're going to talk about currency conversion, because now Canadians are feeling the stretch of the other way, right? Like, we've been buying US stocks primarily through my entire investing career, and the biggest return next to the capital gains is the conversion on the Canadian dollar. Now, a lot of Canadians prefer to buy VFV over VOO. They are both the exact same holding, but one of them is auto-converting the currency in the stock price. And now that the Canadian dollar has flipped up to 71 cents and over the last month is rebounded by about 1.3%, we're now seeing the loss in VFV on the dollar conversion. Now, I keep all my money in US dollars, US accounts. I don't really care what the dollar conversion does, but you are seeing it in my portfolio overview, because this is calculated in CAD, and that's why I'm only up 2.56%, because most of my holdings have returned a bit more of that in totality since the beginning of the year. But we're currently sitting, if we look at VFV, at 2.49%, actually pretty much in line, actually slightly a bit higher, probably with the dividend as well. If we take a look at the other holdings, though, Shada, my SCHD, has not been doing all that great. It is up 2%. I'm very happy with that return so far since the beginning of the year, but I think it's going to continue to lackluster, at least until we get some more assurances on interest rate cuts. It has not compared to the same performance of VDY, but this year it's outperforming VDY, because VDY is basically flat. My VDI until I motherfreaking die. VDI, I'm going to start calling Shada and VDI. But VDY has done great over the last year, but now is starting to lackluster on the back of the Canadian stock performance, especially those upper weighted dividend stocks like the banking sector and the energy sector, with Enbridge pulling this down a bit. But I'm very excited to see where earnings go, because Enbridge posted great earnings. I think the banks are going to do fairly well into this earnings season, which will be coming out in the next week or two. Subscribe, because I'll obviously update you on the bank earnings. Now, when it comes to the individual stock plays, this is where people are getting very excited, concerned about why I flip-flop on some of these, and my flip-floppery is nowhere near as bad as Meet Kevin's, who dramatically underperformed in his ETF. If you held it, you got wrecked, and now he's closing the ETF on top of you. If you don't know me, Kevin, that's lore for another day. Maybe we'll talk about it on the live stream. But TELUS has been a flip-flopping master of mine. I think in total, we probably lost money. We never owned a huge position in this. Like I said, we sold the wife's position out a few months ago. I ended up buying a little bit over the last few weeks, just waiting till earnings came around. And then I sold it because of the guidance that, Bell was offering, Rogers was offering. The guidance was abysmal. The stocks tanked further. And I didn't want to be a part of that. And I actually took a bit of a gain on it because I was buying it around the $20 range, sold it at, $20.90 before it started to drop off here again. But then earnings came out, and guess what? Things were way rosier and actually far better than I even anticipated. So I had no problem buying it back. I told you guys, like, I'm not materially building this into a huge position, at least until I'm confident on where the company's heading, because I think we are now finally in a bottom and we're going to see a recovery for this Canadian telecom giant. So I did buy back quite a bit more. I almost doubled the position from the initial starter position I had. And guys, the money that I'm putting in here is nothing. It's not even a drop in the bucket of like the combination of what the wife and I own. Like it's literally so incremental. It's not even going to make an impact to any major extent, but I am looking to outperform with some Canadian stocks that aren't weighted that heavily in VDY. As I told you this year, I'm going to pick probably 1 to 3 Canadian stocks that I would like to build out to kind of balance out VDY a bit rather than say buying XCI or something else. So right now it's about 1% of the whole portfolio, and I probably set it up on a drip or something or keep cost averaging, but I got a 5K I threw in there this week. Very confident, and now the stock continues to perform well since basically the beginning of this year being now one of the best performing Canadian stocks. Obviously, I didn't catch the bottom. Our average buy price is now around, or my average buy is around $21.50, but we're still doing pretty good today, right? Up 0.65%. When it comes to Google, and I want to talk about this a little bit because Google, in contrast to Meta, they're like night and day performance stocks here. And I really think Google should be trading in the 30s. I said the same thing about Meta. I said both these stocks were trading in the mid 20 to 25 PE range, and I think it's underdeserved. I think the stock should be trading in the 30 multiples with many of the other AI and tech plays out there. Tesla can trade to the moon, and these companies are growing at a 30 to 40% clip on their earnings per share. I don't know why they're trading like normal tech companies. It's kind of perplexing to me. So I saw them as the biggest value plays, and Meta and Google, between the wife and I, they make up the 2 largest positions between our accounts. They make up over 10% of our combined portfolios, and I'm going to continue to keep it that way because they're great companies. But Google has been the lagger of the bunch and is trading at what I think is a wicked discount right now. My average buy across all accounts I think is somewhere closer to 180, and I'm very excited to see what happens coming out of the trials in April for their monopolistic fines. But Google, I think, is largely the only clear buy in an overvalued market, and this is why it's going to be hard. I mean, obviously we want to cost average into index funds, but when it comes to index funds right now, I think global diversification should be a prevalent goal to any U.S. investor or any U.S. focused investor right now, because we're seeing a rally and a return to many other countries with their stocks, which I do want to talk about in a moment. However, let's talk about the 2 other big individual stock plays that I'm focused on. Firstly, Aduro Clean Technologies, right? Aduro is a company that you cannot look at for the volatility as a small cap play. It is going to be volatile. It'll do probably 20 to 50% mood swings on a regular basis. It's got a really tight float, a lot of insider ownership, so the stock doesn't move a whole lot, which gives me a bit of confidence knowing that the insiders believe in this technology so strongly. If you're new to Aduro, this company is basically has a technology to reconvert plastics back into reusable fuels, technology that has never really existed before. Very few competitors. All their competitors are typically trading up at almost $1 billion range. This company's not, and I believe it has better technology. I know a lot of people don't like small caps, but this one has a special place in my heart, and I have a 1-year time horizon target. I am waiting for them to convert one of the 10 customer engagements they have with 40 plus to 100 billion plus dollar market cap companies that are testing this technology out, and I think they're going to convert one, and when they do, I'm suspecting this will trade next to its peers, or should be trading beyond its peers because the technology is better. So I'm speculating in a 1 to 2 year time frame, this will be a $1 billion plus market cap company, and that is a speculative play that I've mitigated in my portfolio. I do want to buy a bit more still. It's trading at about 1.24% range of the entire portfolio today. But putting that aside as well, my other big play for the year is going to be Take-Two, and this is only going to be a short time play. I'm looking at this as purely a social arb trade, as the dumb money investors like to call it. I think people are under recognizing the huge growth potential that is going to come from Grand Theft Auto. It is the legacy media. It is the largest, most valued piece of media ever produced. Set records 10 years ago, and this time around, I think they're going to sell over 100 million copies, and they're going to generate over $10 billion. In my opinion, and I'm speculating, in the first week of releasing the the game. And I think the stock has not justified the value yet because most investors are still focused on AI. Now, don't get me wrong, this company has rallied aggressively over the last year and definitely since its lows with the rest of the market. I think it is overvalued for the current growth that they have, but I don't think it's overvalued if we consider the spike that Grand Theft Auto is going to provide. So I'm expecting that if the market if we go into a downturn or a kind of black swan or something happens where we start seeing value corrections in the market, I think this thing has potential to drop by up to 50%. I think that's some of the downside risk. But when Grand Theft Auto drops and the media and people actually pick up on what the reality is of this game, which is going to be iconic, it is going to be a social phenomenon, that this thing is going to be trading somewhere between 50 and $100 billion. And I've been aggressively buying the stock this week. It now makes up about 2.1% of the portfolio. It's still mitigatingly small, but most of my new invested capital is going to be going into this stock. And I know that might be a bit aggressive for somebody that's mostly a passive ETF investor, but it's not often that I find a level of comfort in an investment where I feel so confident about what's coming. It kind of feels similar to me with the MJ boom, the cannabis boom back in 2018. I caught that so early. I wish I got into this one a bit earlier, but I still think there's huge potential for room to run. This is not financial advice. These are just plays for me. I do want to make this somewhere between, I'm hoping to scale it to probably about a 20 to 30K position, and I'm very excited to see what happens when GTA actually drops in the fall. I'm hoping a lot of investors still don't pick up on it because, like I said, I do want to accumulate this throughout the next 3 to 6 months, and I will sell it probably as we see the numbers come in from GTA because I think they're going to be absolutely meteoric. It's going to be absolutely insane, right? So that's where I sit with kind of my portfolio, and I'll broad view a bit more what I want to do with the gains if we see the plays work out between Take-Two and Aduro, because again, these are more shorter term plays. I'll talk about what I plan on doing with them longer term in a moment, but let's talk about longer term, shorter term, what's going on with multi-billion-dollar hedge fund managers out there like Ray Dalio, who recently basically bought Tesla stock, and Elon tweeted that this was a smart move. And I'm very intrigued by this because Ray Dalio, for a more conservative investor, has been getting much more aggressive with his investments as of late, which I find really intriguing in a very speculative, hyper-inflated market for him to be buying stocks that just make obliterately no sense, that have had not the best execution over the last couple years, like Tesla, where we know sales are plummeting right now, yet trades at absolutely absurd values with, I don't know if it's robotics or, what. I'd love to get Ray Dalio's opinion on this because we haven't actually seen any direct opinion, but he only bought 62 million worth, which might get people really excited. Like, oh my God, he's buying 62 million. But in the comparable to what he owns already, or at least what we know he owns, it's not even a drop in the bucket. I mean, the guy's got $4.8 billion in SPY. 4.8 billion. I mean, that's only 22% of his portfolio. And then you scroll down and he's got like 3 billion huge positions, $600 million position. Sorry, I misspoke. He's got 4.82 billion in SPY. He's got 1.2 billion in IVV and almost $1 billion in IEMG. So these are all just global market funds that make up the vast majority of his portfolio, at least almost 30%, right? Over 30%, probably 1/3 of the portfolio. But then he's got huge positions in Google. In contrast, Google makes up like 10x the value that Tesla does in this portfolio. Same with Nvidia, Meta, all these stocks. In fact, it would be the lowest weighted position in his portfolio today from basically the last updates on hedge follow. So I'm not like overly excited, but I'd love to know the reasoning behind that, and if it's just purely robotics, because I don't think the value of the auto sector, self-driving, you name it, even the energy sector, aren't going to come close to justifying the value of Tesla today in the next 5 years. I just don't see it, but I could be wrong. I'd love to know what you guys think if you're Tesla bulls. Outside of that, where I am bullish but have not put a position on to my own regret, is the Chinese sector. I've talked about this a lot. I haven't been rushing into it, but there's been a lot of hype with the recent partnership Baba has with the iPhone maker that is Apple, because Apple wants to use AI in their phones, but China will not allow it because there's a lot of data collection. So they said, hey, you can use AI so long as it's one of our companies. So they partnered with Alibaba, and that has led to quite the rally over the last few months. In fact, Alibaba's up 46% since the beginning of the year, and I will argue it is still astoundingly cheap. The Chinese sector, especially with Alibaba, some of these Chinese stocks, have not fully recovered. I think they have plenty of room to run here, and I've been constantly contemplating on doing a starter position, and it is something that I'm kind of flip-flopping on when I might buy a bit of it, because I do want some more of that global exposure. But it's just something that hasn't, pertainably came up with capital I have. I only have so much capital to invest, and I'm kind of regretting not buying this sooner. But, there's been a lot of hate in the Chinese markets, but we have to recognize that, like TELUS, if you are a dip buyer, if you believe there are better value outside of tech companies today, like I do, you sometimes have to look abroad. You sometimes have to look at other sectors of the economy that haven't been doing so well. And Alibaba, when you look at the revenue, this company is barely trading at 2 times revenue right now, which is crazy to consider, considering most tech companies. I mean, Tesla generating what, like 100 billion or something annually, and they're trading at, over $1 trillion. Like, it's kind of crazy. Most of these tech companies can trade anywhere from 10 to 50 to 100 times revenue, yet these Chinese stocks just aren't. And they're starting to have a recovery in revenue, right? If we take a look at net income, this is what we're really got to pay attention to, is their bottom line is starting to recover. Earnings are really starting to bolster up again from the lows, yet the stock has not recovered to the same extent earnings has. They've been buying back shares insanely aggressively. Something tells me their earnings should be pretty good for this upcoming quarter. I might pick up some shares for the earnings on the 20th, but I would have liked to see the steam burn out of this a little bit. I'm kind of not much of a chaser, but over the last 5 days when the stocks ran 16%, and since the beginning of the last rally up 54, I would expect some profit taking at some point. But yeah, if once I get my taxes done, I'd like to maybe own a bit of this in my RSP perhaps, but we'll see how I feel about it. I have been looking at JD.com and many of these other Chinese stocks as well, as they start to head back into recovery mode. So do I buy some of them? Potentially. I'll just subscribe. I'll keep you updated if I do. There'll be incrementally small positions overall, but I do like the fact that Michael Burry took these pretty aggressively when people were really hating on them. And there's been a lot of hate on these Chinese stocks, which I don't think is relatively deserved, because they are some of the largest companies on the planet, and he is starting to see quite a return. But do keep in mind, the same guy that is buying, this Michael Burry, who shorted the 2008 financial crisis and made a fortune, he's made really good investments, upper weighting these. Almost 50% of his portfolio was just in Alibaba and JD. But keep in mind, this was a guy that went really heavily on Bed Bath & Beyond, lost almost all that investment, and quite a few other stocks. So again, not financial advice, but intriguing nonetheless. And I want to well balance your perspective on an overinflated market when the PE ratios are absolutely astronomical, to look at broad-based ETFs like XEQT, that because they have this broad-based exposure, they are picking up steam, right? They're up 3.8% so far this year, doing quite well. Same with like VT. I really recommend global market funds, because again, in market environments like this, where the US, I think, is eventually going to have to pay the piper, it's going to have to come back to a place of reality eventually. I do think AI is a large bubble today, and it's going to take up to a decade to actualize any of the value we see in the market in that specific sector today, that it's important to understand that other markets will recover when it comes to Hershey, Nestle, these European companies, Alibaba, these Chinese companies, Japanese companies. We're seeing a lot of growth in things like Nintendo right now, and you get that exposure through these broad-based ETFs, which is why I think it's so prevalent. Look at like Taiwan Semiconductors and getting exposure to some of those outside of stocks necessarily, just like Nvidia. Now, my plan with my portfolio long-term is to basically start by the end of this year. Like, this is a year where I'm going to go hard into a couple big bets that I have, and that's going to be Take-Two. I'm looking at Aduro, and those are like Google, Meta are my very long-term ride or die stocks. Aduro might become that depending on how execution goes over the next year. Take-Two is only going to be short-term, but if those things actualize to outperformance and I start taking those profits, I'm probably going to sink all of those profits into XEQT as I start rounding my portfolio off to what I want to see as basically a long-term, wealth preservation, perhaps over growth. I'm not going to chase growth as much as I used to as we start finishing off paying down the mortgage. Like I said, my primary goal is to get the TFSA maxed. I have $60K worth of room in my account. The wife has about another 60 or 70. The mortgage we still have to pay down is equated to 100, 150. But once I get to that level, my perspective on how I manage my portfolio will probably change. I'll probably still manhandle, if that's the right word, some individual plays that I see prevalent, but I do want to, again, focus on preservation. But as it stands today, and as those that bought my courses know what the wife and mine accounts, or our accounts, look like combined, and you can check them out over there, and I'm still very happy and very sleeping comfortably at night, but I am recognizing that, we're getting to a very incredible place that has taken a decade to get here. And I appreciate every single one of you that have been following, that have been, doing this with me, as many of you in our chat group have excelled into 6 and 7 figure portfolios. And I feel like this is one of the strongest communities on the internet. I like that there's little criticism as we're all trying to do something incredible together, which is fight for financial independence, to not have the ball and chain of debt and being stricken to jobs and a lifestyle that we just don't atone to. And we sacrifice today to have that lifestyle we want in the future, that freedom. I think it's a beautiful thing. But I'd love to know what you're doing with your portfolio and how you feel about what I'm doing in that comment section below.